Newest indicators show inflation continues to be a little sticky as we await the Fed's decision on the final rate cut of the year. Wealthion is here to give you insights that'll help you navigate your financial future. I'm your host, Andrew Brill. Welcome to Wealthion's weekly market recap. Let's see what our experts had to say this week. Jack Mallers, CEO of the crypto platform Strike, was Anthony Scaramucci's guest on Speak Up this week. What is Strike? Jack answers that question for you, also talks about why you should consider investing in Bitcoin. Jack also talks about the global implications of Bitcoin.
Why somebody needs to know about Bitcoin, why somebody needs to at least think about investing in Bitcoin and making Bitcoin part of their investment portfolio and part of their lives, who's in the position that I just described.
Yeah. Well, I think fundamentally Bitcoin is designed to be a superior asset for you to hold. We can spend hours on this podcast talking about how and why that is. I think simply put, it's because it's the hardest asset you can hold. And hard is in reference to how hard is it to make more of it? How scarce is this thing? And Bitcoin is the scarcest thing you can own, period. And what do I mean by that? Well, Anthony, if everyone listening to this wants an iPhone, Apple can increase the supply of iPhones and get them one. If everyone in the world wants a McDonald's cheeseburger, McDonald's is going to find a way to get them a cheeseburger. Equivalently, if the price of gold goes up 10x and everyone is in demand for gold, Elon told us he's going to go to some other planet and get more. So the idea in financial markets is with more demand, you will find more supply. You always will. Now, Bitcoin is the only thing you can own where that's not true. With more demand, we cannot find more supply. No matter who you are, no matter where you are, no matter what you are, we can't make any more. And so it's for that reason that more demand has to find a higher price, because the more supply that's being demanded is coming from the market. It's coming from the existing holders. So if you want more Bitcoin, you got to bid it to a higher price. And it's the technology and the innovation and Satoshi Nakamoto's breakthrough that's built such a scarce thing. But fundamentally, why you would hold it versus other things is because it is harder, because it is scarcer, and because it will outperform and find a higher price for those fundamental reasons.
You and I agree on all that, but you created something called Strike. Mm-hmm. Tell me what Strike is, and tell me how Strike is used by so many different people. What's the value of Strike, and what's the future of Strike? Where are we 5 years from now with Strike?
Yeah, so the reality of Strike's founding was baked into this idea that crypto at large was born. And you and I may differ on this, where there was now, so just a reminder for everyone, I'll say it again, I've been in this space for 12 years. So end of 2012, early 2013. And so I was around when there were no altcoins. There was just Bitcoin, or there were scrappy ideas, but they weren't to be taken seriously. So I watched the birth of Ethereum and the birth of Litecoin and all of these coins. And when I saw businesses like Coinbase start to pivot and make that their main focus, it doesn't make it a bad business. In fact, Coinbase is a public company. You can go look at their financials. It's a good business. But I disagreed with the opportunity and what their focus was and who was serving the Bitcoiner as a customer. And so when I founded the company, I was in my mid-20s, and it was really that I thought Bitcoin was the opportunity, that speculative trading and high-risk assets like cryptos that I thought weren't like Bitcoin at all was a distraction. And I thought that there needed to be a financial institution that actually enabled all of Bitcoin's potential for customers, and that Bitcoin financial services like buying it, selling it, storing it, moving it, getting insurance on it, borrowing against it, using it for cross-currency payments. No one was working on these things, and everyone was waiting for the new coin. And so that's when I founded Strike, and we really found our stride after the industry blew up, believe it or not. So when FTX went down, when BlockFi went down, we saw a ton of growth in customers that were like, I value Bitcoin. I think it's the pristine asset. And what I'm looking for is a financial institution I can trust that's the best in class at Bitcoin and that focuses on Bitcoin financial services. And so when I founded the business, really, I mean, my whole career, I was like, well, Mt. Gox is going to be the Bitcoin company for the world, and I'm just happy to be here. And that didn't turn out to be true. And then I thought, well, Brian Armstrong surely is going to figure that out. And he doesn't seem to be as interested into Bitcoin as I am. And then I thought Sam Bankman-Fried and Binance were 10 times smarter than I was, according to the media. And that turned out not to be true either. And where we found ourselves is the most licensed, regulated Bitcoin-focused company in the world, that our customer is the Bitcoiner. Our customer is those that are looking for high-quality Bitcoin financial services from a compliant, regulated, trusted custodian. And that's who we are right now. And I think we're going to have a lot of upside running that business over the last 10 years if we can continue to do what we've done. That's my thesis.
What you would say to other countries in that situation. So question one, are other countries going to do what El Salvador has done? Is that your prediction? And then number two, what would be the messaging to these other countries? What would you say?
I think so I'll take the second question first. Whether you're a country or a family or a corporation or an individual, especially in lesser served emerging markets, what you're looking for is growth and stability. These people, as a reminder to everyone listening, you can't buy Apple stock. You cannot invest in Miami beachfront property. You don't have access to index funds from the smartest financial minds in the world with the biggest capital bases of all time. You have maybe the Naira, and that's it, your local community shillings. And so the fact that you have an asset that on average over the last 10 years is 63% annualized return. So it's the fastest growing thing that any of us could have owned. I mean, it's accessible to everybody. So it is a life raft in that sense. And whether you're a country and you are in debt, listen, we talk about these metrics like debt to GDP. How much have you borrowed versus how much growth are you producing to pay that back? We're all looking for growth. And you could buy growth off the shelf. All 8 billion of us is a way to think about it as a government. If you're interested in growth, if you're interested in productivity, you could say, I'll take a burger, small fry, a Coke Zero, and 63% year over year growth over the last decade. That's not a bad deal. That's not a bad lunch order. And so for the individual and the family, it's very similar and the same. For El Salvador as well, these people don't have access to Google engineers. They don't have access to minds like Michael Saylor. They don't have access to consumer innovative minds like Jack Dorsey. But being a part of Bitcoin, they did. They were benefiting from the work of MIT professors, from Michael Saylor, from Google engineers, from Jack Dorsey, from the world's work on an open distributed network. So you're joining a global team of the smartest minds and the most powerful computing network in the world, and you get access to the best performing asset that's even outperforming guys like Ken Griffin. And that was the message, is that join this team. Network effects and economies of scale are going to take you. You actually need to humble yourself. This goes message to myself in the mirror. Humble yourself. You're not the main character. You're not going to advance this any more than the greater good. And so just be a part of it. Be a part of it. Realize it's bigger than you. And that's when you start to gain net benefit, is when you realize I was wrong about this thing. This thing is bigger than me. And all I need to do is subscribe to it and align myself with the fact that it's a system with equal rules and equal rights. And, it was better to buy it when I heard about it, but the second best time is now. And that's a lot of the conversation with them. And for my speculation on countries, I'll keep this one short. I actually knew fairly quickly that we were not going to see other Latin American countries, because El Salvador was unique in this way, Anthony. They didn't have their own currency. So for those that don't know, they lost their own currency in a civil war. So decimated the whole place and really put it back many, many decades, and violence and gangs and a lot of civil unrest. Whereas people like to compare Argentina, Malay, yeah, but they get to print money. If money's our time and energy in an abstracted form, it's very difficult to forgive the ability to print that, to print time and energy. And so I couldn't really figure out, maybe there are economies and markets in countries like Panama, but it was not going to happen from another country that could print their own currency. And I almost took that next leap and thought, well, who with a central bank and with a money printer is going to adopt this? And I did genuinely, I swear to you, I thought the United States. And I thought the United States, because the world reserve currency status, we have so much debt. And what do you want to back your debt with? And really the way I think about it, your future promises. You want to instill confidence in your future. and the promises that you're making about your future, about your economy, about your stability, about your ability to harness technology, about your ability to localize and grow talent in the country. And that to me was Bitcoin. And so it doesn't surprise me that it was part of this election and that we're still hearing positive rhetoric from this new administration. So that's more my prediction, is that if we are going to see a more advanced adopter that isn't El Salvador, that didn't even have their own currency, I do think it's going to be the US, believe it or not, before it's someone like Argentina.
Are you concerned about your financial future or think your investments could be doing better? I'm Andrew Brill, one of the hosts here on Wealthion, and I've been there. Not sure my money was in the right places. It's why I've gotten help from a financial advisor. Maybe it's time you think more about your financial future or get a second opinion about your investments. We've made that process easy. Simply go to wealthion.com/free to speak with one of Wealthion's registered investment advisors for a free, no obligation portfolio review. Again, that's wealthion.com/free. I'm now less anxious and confident I can achieve the financial goals I've set for me and my family. Henrik Zeberg, the head macro strategist at Swissblock, joined Wealthion this week. He explains the business cycle and the inflationary environment that could accompany the incoming administration. Henrik also believes we are in one big bubble, and he explains the totally different approaches of Michael Saylor of MicroStrategy and Warren Buffett.
And before we do a deep dive on where you think these specific markets are going, why don't we first just touch on your analysis and how you and your approach? You use a business cycle approach. Just tell us a little bit more about that.
Yeah, so my business cycle is based on three different indicators. There is the leading, the coincident, and the lagging indicators. The leading indicator, and these are all data that we can get from the conference board. You can get it from Fred. There is just data you can get online actually. So it's not something in a magic box, but it's the way you also use these things and how you understand that they are actually the sequence of things. And I think that is where a lot of people are. What inflation is that before you see the economy is developing in a certain way and so on. And this is actually the sequencing of it and the understanding of that, which is extremely important. So what I see is that we have had the leading indicators leading the economy into a slowdown. And I've been waiting for now to see that the coincident indicator, which is the real economy, which is the production level, it's the NFP numbers, non-farm payrolls, and so on, actually starting to show that weakness. And then you have the inflation, the rates, the yields, which is the lagging indicators. For now, we've seen the leading indicators been declining for 24 months or so, and which is the equivalent of what we saw into the financial crisis. And we're actually starting to see that the lagging indicators in my model is starting to show a lot of weakness there, which is a little funny because in that, in the time between there, we should actually have seen the coincident indicators, meaning the non-farm payrolls that we had on Friday, should start to deteriorate, and the labor market. And I actually think that is happening underneath the hood. And if you really look, closely, you will actually see that the non-farm payrolls that we're getting out these days are just, I don't trust them a lot. Let's just put it like that. So I think the economy is in a much worse place than most people actually understand at this point.
And one of the big unknowns about 2025 is that we have a new administration coming in, and there's going to be a lot of changes, a lot of policy changes, deregulation, taxes, reduction in taxes, an increase in tariffs, and also changes to immigration. And we really don't know the impact, what all of these changes are going to do to the economy. But to me, a lot of them will be inflationary. Like if you cut taxes, that's going to be inflationary. People are going to spend more. If you impose tariffs, that's going to result in higher inflation. Are you not concerned we might see a pickup in inflation in 2025?
Yeah, sure. Absolutely. But again, I think that's what I talked about also on previous shows. I think there's going to be a whipsaw. So I think that what we're going to see is that the deflationary forces that are in play right now are in control. And that we can see because people are not spending, that as they should, and we see the consumption simply not being there where it's supposed to. So we don't see a pickup in that, so inflation could become a problem. In order for inflation to become a problem, we need to see exactly that. We need to see excess spending. We need to see that the money starts to circulating fast and faster. We don't see that, and that's why I say that the deflationary forces of the economy right now is in control. And I think the Fed is scared of some of these things here and what it unleashed. And that's why if you look at the momentum charts for inflation, and for also for yields also, then the momentum is to the downside at this point. What you're then talking about is things that will come through and will be happening at some point in 25, but that's not creating inflation at this point. That will create the opposite again. And that you can have the perfect cocktail there, because then you may also have the Fed coming out blazing because they say, oh, now we stare at inflation again in the face. They will have to do something, and then you have all the things that can come out there from the administration as well. So yeah, I do fear inflation, but not at this point. And again, it's not just about one direction or the other. Actually, these things can turn pretty quickly. And especially if you have a downward force and you got all these things setting in motion, then the upward force on inflation can be setting in during 25, late 25, I would think, and then into 26. And that would be the next problem, especially if the economy is still sluggish. And I think it will be, because then you'll have the worst thing you can have, a sluggish economy while inflation is picking up, which is stagflation. And that will be bad for a lot of people.
And I think one of the things that really shocks me about this market, or maybe in the last 5 years, is it's just not one bubble, but it's mini bubbles, right? It's what John Maynard Keynes called animal spirits, and that's what's feeding everything. Oh. And I guess it has to do with cheap money also, but cryptocurrencies, right? There's over 9,000 different types of cryptocurrencies now. NFTs, yeah. You may recall, I think it was in 2021, somebody paid $69 million for an NFT by an artist by the name of Beeple. And then we had the metaverse. And that was another bubble. Now nobody talks about NFTs or the metaverse. And now I guess the big bubble is anything and everything to do with AI. And the poster child for AI is NVIDIA. And it's up 180% on the year. But maybe you can just speak to these bubbles. And I know you're a real student of the market, but how does this time we're living through right now compare to other bubbles? And why do you think it just keeps going from one asset class to another?
So I don't think we're talking about many bubbles here. I think we're talking about one big bubble that is just, keep developing. And we haven't really seen the popping of that. We've seen a decline in the markets, but it was saved again, also even in Corona, and all the things we have seen over the last few years is just, adding up to the big one that we have right now. So I think I talk about what we have right now as the everything bubble. We have a bubble which includes, crypto and AI and everything we have, because everything has been, just been thrown money at it. And that's what we see developing. So I don't think these are, small new things that are coming. It's just part of the whole thing. And that comes back to the whole, what is the driver of this? First of all, it's the easy money, environment we have had for so many years, and it's been changing over the last few years here. And I think that is what's going to change do a big change down the road. But until you can say that the inflation started to move up, we saw that money was just thrown at everything. And we had these new technologies coming out. We had AI, we had blockchain, we have all these things, which are wonderful technologies, and they will change the world 100%. They were going to change the world, just like what we've seen so many times before when the railway came out, and we had the technology of the steam engine in the 1850s. You had the automobile and so on in the early 1900s, and all these things are technologies that comes up. And what happens every time around that? You can also go back and 180, 170 years to look at around the railways, at the railroad and the steam engine. You have bubbles emerging from that. You have, companies popping up and say, oh, now this is going to be something fantastic. And everybody's trying to figure out how it all fits in. And that's what happens this time again. So you're talking about those, thousands of cryptos there. I can tell you that I think 99% of those and 99.9% of those are going to be worthless within a couple of years. And I'm even in some of these right now. So it's the technology down beneath. It's the blockchain technology. It's the AI, but it's not the whole speculation around this right now. And that is where market is sometimes front running things and try, oh my God, this is fantastic. And they're just throwing the money into it, which builds up the bubble that then bursts. We'll see some, big declines in the market, and we'll see also a lot of failures in some of these, exaggerated, in terms of valuation of companies. And then we'll see that the real ones will then emerge from this, the whole decline. So you will see that there will be another, whatever it's going to be, Amazon or whatever we saw after the 2000 also bubble there. So we will see that. but it's not going to be the thousands or the hundreds of them that everybody seems to believe now. It's going to be the normal cycle as I see it. We're going to have the bust. We're going to see a lot of these fail, and then we'll see a few of them emerge, and there will be a real business case on those. And that will be due to the technology that is behind this, the technology that will drive. But it is not that will save the world at this point. We will have the bust, and then the fourth, industrial revolution is going to be set in motion by some of these technologies. I'm quite certain of.
I touched on NFTs, but I don't know if you saw that recently. There was a cryptocurrency investor. His name's Justin Sun. He paid $6 million for a piece of art, which was essentially a banana duct taped to the wall. Did you see that?
Yeah, I rest my case. I mean, this is the craziness. This is the stupidity that we see in every cycle. And every time we're told that this time is different and no, and you don't understand, Henrik. And I know this is the thing. So yes, I did see that. And again, it's just like another tick in the box saying, okay, we got this kind of stupidity. Obviously, we're getting closer to it. So yeah.
But what was even better is that he called a press release, I guess, just to probably did it for publicity. And then he actually ate the banana.
Yeah, I saw that. Yeah, I saw that as well. Yeah.
Henrik, we can't discuss Bitcoin without talking about Michael Saylor and MicroStrategy. MicroStrategy was up 500% on the year. I wish I was long, but I'm not. And now it's up, I think, just over 400%. It's pulled back quite a bit, and because he's raising money. And I don't know if you heard, but Michael Saylor has implemented this 21-21 plan. He wants to raise $21 billion in cash, $21 billion in debt, and he's going to put the proceeds into Bitcoin. And I'm not even sure how much he spent thus far, but do you see this as another sign?
Oh yeah, absolutely. And him, appearing on TV and talking about on media, talking about how we should, U.S. should sell all its gold and buy Bitcoin. I mean, complete craziness. I mean, stupidity, honestly. So just to be frank here, obviously, this is again I actually had these very high targets on MicroStrategy. I could see it also, and I actually think I haven't studied it just for the last couple of weeks here, so I could see there could be another high on it because I think they're going to follow Bitcoin. So I think with this Bitcoin has not found its top yet, and I think there is a significant upside still on Bitcoin. Well, so I think MicroStrategy can move even higher here, but. It's again, I have to say, and we can be on here again in a year's time. I think when we sit here again next year, new Christmas tree, MicroStrategy will have crashed, tremendously, and just like straight down to a certain point also. So it's what he's doing here is a very dangerous game, and just about betting all your whole existence on a crypto, on Bitcoin, and just saying it's just going to go up all the time. It's yielding zero. And if we get a deflationary bust that I'm talking about, and we get a stagflation as well, Bitcoin is not going to do very well. So I think it's a very dangerous game that he's playing, and it will work sometimes, and then we know he'll be a villain for a certain amount of years. But I just think this time around, if we get the lows that I can see in Bitcoin coming in after this top here, then it's not going to bode well for MicroStrategy. But hey, he's up a lot of percentages at this point. But we have seen this before. We see how things go straight up, and then in the Eiffel Tower, it normally comes straight down again. I think that's going to be the case here as well.
So it's interesting to see Michael Saylor going all like risk on in a big way, and he's going all in on Bitcoin. And then Warren Buffett, he's at the other end of the spectrum, and he's raising cash. He's sitting on a record level of cash right now, $325 billion.
Yeah. I think if I have to choose between the two, I know who I'll put my money on that. And I think it's, it's again, in a crazy world, the crazy person will seem normal. But the problem is we are in a crazy world right now. So the crazy people are the ones that will seem normal because they do the crazy stuff. Fact is, in the real world, and then we will get back to it when we see the bust also, the way of running a business like what Warren Buffett does, and obviously he's been proving, who am I to actually even just talk about that? He is, he as I see it, this is the way to do things. And at this point here, when you have crazy valuations, you want to raise cash, you want to make sure that you are ready for the next decline, you get ready for that, your credit lines and so on. And then let the crazy people talk about buying Bitcoins and selling gold, and and doing, and buying bananas from his duct tape to the walls. I mean, these are the kind of things we see in the crazy worlds. And again, I said the crazy people will seem normal for a certain amount of time until the point where the shit hits the fan. But that's not a popular thing to talk about. So when I talk about this with people, they'll say, oh, Henrik, it's because you don't understand it. You don't understand AI. You don't understand crypto. So that's why this time you'll be different. This time is different. And let's see.
Jesse Felder, CEO of Felder Research and author of the Felder Report, joined us this week. He's concerned about CEOs cashing out chunks of their own company stocks. He believes this is a sign of things to come. He also discussed what a strong dollar means for the stock market. Jesse also spoke about passive investing and what it means for retail investors, along with the possibility of a major market downturn. Is the strength of the dollar a driver behind a lot of foreign investment into the U.S. stock market?
Yeah, I mean, one of my favorite charts is there's almost a perfect correlation between the relative performance of U.S. stocks and the dollar. Right, U.S. stocks outperform foreign counterparts when the dollar goes up, and that's just a reflection of dollar. Money coming into dollars. Where does it go? It goes into the stock market. I thought it was interesting. Ruchir Sharma is one of my favorite editorial writers for the Financial Times. He's the chair of Rockefeller International. He wrote an interesting piece last week about, he called the mother of all bubbles in the U.S. stock market. And he kind of outlines this point that U.S. stock market has been a magnet for foreign capital for a number of years. And he was at an investment conference in Singapore recently. The moderator asked how many people in this room don't own NVIDIA, and not a single hand went up. So it just tells you, globally, everybody, wants to own the Magnificent Seven and all these stocks. And that is a trend that coincides with dollar strength. So if we are seeing potential another peak in the dollar, similar to kind of what we saw in that 2002 timeframe, then we're going to probably see the outperformance of U.S. stocks potentially reverse course, and real assets probably outperform financial ones generally, just like they did from that 2002 to 2012 timeframe.
So as the incoming administration and Scott Bessent trying to devalue the dollar a little bit, that would mean that there could be an outflow of cash from U.S. stocks at that point, couldn't there? And that could I don't want to say cause a crash, because I don't want to set off any alarm bells, but it could seriously go down a little bit.
Yeah, there's a lot of foreign capital in U.S. stocks. I think there's evidence to see, Japanese investors, Korean investors, even Chinese investors have poured a lot of money into U.S. stocks. I think, honestly, the bigger risk I'm concerned about in the short run is not necessarily foreign capital flight. It's the fact that the few active managers left in the market today have realized the only source of outperformance or even generating returns is trying to front run passive flows. So much money has gone into passive, and Mike Green wrote an interesting piece on this over the weekend about how, literally value investing hasn't worked. Reversion to the mean hasn't worked in any respect in terms of for active investors. And what has worked is momentum. And the momentum factor over the last 12 months has had one of its, best 12-month performances in history, going back through the market. I mean, I think it's 1999 and 2021 are kind of the only times we've come close to what we've seen. And I think that is just a function of active managers, hedge funds and these types of things, realizing when there's a lot of passive money coming into the market. We've seen record inflows into Vanguard funds and passive vehicles this year. The best way to make money is to front run those flows. And so you get a compounding effect in the markets where everything is highly leveraged to flows. And that obviously creates some fragility, because as soon as those flows, peter out or reverse course, everybody is on the same side of the boat, and that trade reverses. And I think that's something that not enough people are really paying attention to. the history of the momentum factor also shows whenever you have a year of big, strong momentum, there's usually a painful hangover on the other side of that. It's a very close correlation. It's actually a very good predictor of 12-month returns in the S&P 500, the momentum factor. So you have a really good, strong year in momentum, typically leads to a reversion in stock prices, broadly speaking, over the next 12 months.
We've had Mike on, and he is very concerned about that passive investing because it's done a lot by algorithms. It's not even someone saying, "Okay, we're gonna invest in this." It's like, look, if one number's off slightly, doesn't matter whether there's a good reason or not, that passive investing could flow in or out very quickly, and it's the retail investor that gets hurt.
Yeah. And I think that, it's as I mentioned, we've seen record inflows into passive this year. And so the best performing strategy in the market has been front run those passive flows. How do you do that? You buy the biggest stocks in the market. You buy the Microsoft, Nvidia, Apple. And, I just look at a stock like Apple trading at 40 times earnings, witnessing its slowest revenue growth and earnings growth over the next, 12 months. It's seen in a long time, and its highest valuation at the same time. To me, that is just the fingerprints of passive, right? Who's willing to pay a record valuation for a company that's seeing its slowest growth, going forward, and that's just price insensitive buyers. And so, on the flip side of that too, you have Warren Buffett offloading the majority of his Apple stake, because I think he's realized these dynamics that, at 40 times earnings, it's not nearly as compelling a prospect to own this stock when it was 15 times earnings and they had a bunch of, stock buybacks that they could implement in the future. I think it's also telling that, Apple's net cash relative to its market cap is essentially nil now. I mean, they essentially have almost no net cash on the balance sheet relative to their market cap, when it was, 15, 20% only a few years ago. So, that opportunity to buy back massive amounts of stock at low valuations is behind it. That's also been obviously one of the drivers. But to me, it's more a function. I think Apple's kind of a poster child of how does passive affect the market? Well, take one of the biggest, slowest growing companies and put a record valuation on it. It's not a coincidence that there's been record flows into passive this year, driving that valuation extension.
Do you see a market crash coming at all, or a big correction?
I think it's foolish to try and predict a crash, but I will say that I think if we did have a stock market crash, I think you'd have to look back and say there were signs, right? And those signs are the strength in the momentum factor, driven by this piggybacking on passive investing, and then the extreme leverage that's being used today. I would just point to, the assets in leveraged ETFs. Bloomberg published a piece, I think on Friday, that showed at the 2021 peak that the assets in leveraged long ETFs were 5 times greater than those in short ETFs. And that 5-to-1 ratio was a pretty bearish signal. Well, on Friday, we hit 11 times. So there's literally, it's twice as extreme, the amount of leverage in leverage ETFs today that we saw back in 2021. There's also things like the Commitment of Traders report. You look at small speculators in S&P 500 futures, and they're about 10 times as long today as they were in 2021. So there's not only is there this piggybacking on the momentum factor, like I said, that I think is front running the passive flows, but they're utilizing such great amount of leverage in order to do that via leveraged ETFs, via futures, via these types of things, that it does concern me that once those flows reverse, and they obviously they always do, right? Nothing goes on forever, and these flows always go in cycles, right? They always go, big year, kind of a reversal year. And so I think when the flows do reverse, I am concerned to see how does the system kind of absorb this type of a deleveraging, because it's really something we haven't seen before.
Good friend of Wealthion, Jared Dillian, was back on Wealthion this week. He spoke about the recent PMI numbers and the future with the new administration. He explains how Trump's pick for Treasury Secretary, Scott Bessent, and Jerome Powell can work together. And Jared is a big believer there could be a turnaround for commodities in the near future. What's your take on the present economy? It's a little bit up, a little bit down, and not sure about the numbers.
Are you asking about the economy or are you asking about the markets?
The economy in general.
Nothing wrong with the economy. The economy's fine. What I'm kind of waiting for is for some of the PMI numbers to come in after the election to see if there's going to be a bump in sentiment. For the last 2 years, really, or year and a half, the PMI numbers have been pretty terrible. And you have to wonder if part of that was just pessimism around Biden being president, and maybe, after the election, people will become more optimistic. But the funny thing about those PMI numbers is that as bad as they weren't really, for the first time, they weren't really a good predictor of the economy. I kind of remember being pretty new at Lehman in like 2002, 2003. And, the Fed paid a great deal of attention to ISM. What they called back then was NAPM, if you remember that, the National Association of Purchasing Managers. And, if NAPM came in above 50, then the Fed was hiking. And if it came in below 50, the Fed was cutting. And we had a very long run of data with the PMIs below 50. And yet the economy ended up being pretty strong, and a lot of people pointed out that divergence between sentiment and the real economy. The economy itself was strong, but sentiment around it was really bad. And a lot of the reason for that was because of inflation.
Do you envision a better scenario under the next administration? You had mentioned maybe the PMI is not doing as well because of the administration, but do you expect that stuff like that will pick up?
I mean, theoretically, yes. Everything that Trump is doing is very pro-growth. The pick of Scott Bessent as Treasury Secretary couldn't really be any better. This is a guy who's focused on, reducing the deficit and cutting taxes, and Trump himself is focused on cutting regulations. So this is going to be a very pro-growth 4 years. Having said that, there isn't really a strong correlation between the stock market and a president's policies. And if you go back to when Reagan was elected in 1980, Reagan immediately cut taxes a lot and cut taxes throughout both of his terms. But the stock market, basically you had Volcker raising rates in 80 and 81, and we had a recession in 1982 and stocks were very cheap. But the point is that, Reagan had been president for about 3 or 4 years before the stock market finally started to go up. So I think a lot of people are expecting that, we're going to have 4 years of Trump and the stock market's going to go from the lower left to the upper right. It might not work out that way, for a whole bunch of reasons. And if you look historically, the stock market, if you just go from start date to end date of presidencies, the stock market has done better under Democrats than Republicans. There's a whole bunch of reasons for that. A lot of times the stock market will be pricing in a Republican presidency while the Democrat is president. But nonetheless, I mean, I guess what I would say is that people's expectations, I think, are a little excessive here.
So if we bring it down a little bit, it really shouldn't hurt all that much, but it may make things a little bit more efficient. That's for sure. So Bessent is going to be in charge of the Treasury. It appears now that Jay Powell will be sticking around until the end of his term. How well do you think they work together?
I actually haven't thought about this before. I mean, probably reasonably well. They both have a finance background. Neither of them are really academics. Bessent is investor. He's a hedge fund operator. And Powell is a private equity guy. I think they're going to speak the same language. We heard yesterday, the day before, that Trump is not going to try to replace Powell at the Fed, which I think is the smart thing to do. I think his replacement is going to be Kevin Warsh, would be my guess, especially since, Warsh was being considered for Treasury but didn't get that. I think Warsh is probably going to be the next Fed chairman.
Do you think the Powell's done a good job in lowering inflation and getting it to a point where it's doing okay?
I think he's done. Everybody I think would have the same report card for Powell. He was slow to recognize inflation, but once he did recognize inflation, he acted very swiftly to bring it down as quickly as he could. So I give him kind of a B minus.
And where do you expect we go in December? We're probably about a week away from another Fed meeting and an announcement of a cut or not.
Yeah, I think we're pricing in about a 90% chance of a cut, and I think that's about right. I think we will get another 25 basis point cut. But the fact, we're cutting interest rates 100 basis points while crypto is going bananas and the stock market is going bananas. And, not that I'm going to blame all this speculation on the Fed cutting 100 basis points, but basically the Fed got spooked by some payroll data and they panicked and they cut 50 basis points back in September, which I think was a mistake. I think I said this the last time we talked. I think I said that in 2025, they're probably going to be taking back some of these rate cuts and actually hiking rates.
So you think that the new administration will be a little bit more inflationary then?
It's funny because there's so many dynamics here. Inflationary. The economy is going to run hotter with Trump as president, than with Biden as president. But my guess is that the Fed, which, not to get into politics, but they donate to Democrats 10-1 over Republicans. My guess is they would prefer tighter monetary policy while Trump is president. And then we're getting into, Trump's stated desire to have a say in the monetary policy process. And, if Trump is agitating for lower rates like he was in 17 and 18 with Powell, then that could, let me just say there's a lot of uncertainty for next year. I don't know what Trump is going to do. I think if Trump doesn't interfere in monetary policy, Fed funds will be higher. But if he does, then we'll see.
So let's get into the stock market a little bit. The NASDAQ right near its high, S&P over 6,000. The Dow is not far off its high. You've written that you're bearish on stocks. Can you explain?
Yeah, I'm bearish on stocks, but I'm not doing anything about it. I think that's my job as a newsletter writer is to obviously recommend trades to my subscribers. And I don't want to be in a position where I'm telling people to go short and then the S&P goes up another 15% and, we get squeezed and it's terrible. And, so my job is to time it perfectly. And, in doing so, I'm paying a lot of attention to the technicals and in the price action, the technicals and the price action. And when I just see how the market trades, it doesn't seem super toppy to me. I still think we have some more upside. If we don't, if the market goes down 5 or 10% tomorrow, I'll be happy. But I do think we have some more upside. So what I'm trying to do is to time it perfectly.
So you're sitting tight for now, but if it goes down 5 or 10%, are you putting more money to work?
Depends on the price action. It kind of depends on how it goes down. But yes, I will probably, there's a portfolio in the newsletter. We have a lot of long positions. And the one thing I've learned about bear markets is that if you have a portfolio of stocks and you think to yourself, well, even in a bear market, this stock is safe, or this stock is safe, or this stock is safe. In a bear market, really nothing is safe. So when stocks go down, they generally all go down. So I will be ruthlessly cutting long positions if the market starts to decline. So,
do you have a feeling about where it might go? You say you're not doing anything about it, so obviously you think there's a little bit more of an upside. Do you have any inkling of where you think the market's going?
No, I don't. I really don't. I don't. Yeah, I mean, this, I look at 100 charts a day, whether it's on Twitter or stuff that people send me or whatever. And, there's a very good research shop called Sentiment Trader, which they're pretty good at putting together quantitative sentiment analysis about the market. And one of the things they've been doing recently is they're looking at advances versus declines, and the fact that we're putting in new highs on successive days with more declines than advances. And they said the last time this happened was 1928. They put out all kinds of good stuff like that. So I look at all this stuff, but the price action is still fine. So,
how are you feeling about commodities? Commodities have been low for a long time. As the dollar devalues and Trump tries to devalue the dollar, you would assume that people might get back into commodities. Where do you think commodities are going?
No, I totally agree with you. I think that's going to happen. And if you look at a chart of a commodity index, like the BCOM or something like that, there's you had a big rally in September and the rally kind of faded and we're kind of forming a base. I think commodities are forming a base over time. That's kind of what I'm waiting for, is for some dollar jawboning or devaluation that's going to get the commodities market going again. I don't think commodities are going to make lower lows. I'm pretty comfortable saying that. So,
is that something you're looking into?
Yeah, for sure. Yeah.
I want to say this politically correct. Do the world events affect commodities? I mean, we're going to have to, or somebody's going to have to rebuild Ukraine. They're going to have to rebuild Gaza. Syria is now in a state of disarray. There's been bombings in Lebanon. So there's places that need to rebuild, and they're going to need infrastructure, steel, copper for wiring, all these things that are commodities. Do you think that helps the commodity market at all?
It doesn't hurt. It sure doesn't hurt. I think that a bigger driver of commodities is China. And, commodities went up in September because of the China stimulus, right? Like commodities skyrocketed. And I think if we get another round of China stimulus, I think that will do the same thing. China, well, we could talk about China for like an hour, but they're in a position where they have to continue to stimulate, which is one of the reasons why I'm not bearish on commodities.
Thank you for watching this week's recap. If you need help planning your financial future, please head over to wealthion.com/free for a free, no obligation financial review. And please follow us on social media. All the links are right below in the description. If you haven't done so already, please like and subscribe to our channel, and don't forget to turn on notifications so you never miss a video. Thanks again for watching. If you like this content and are looking for more ways to keep growing your investments, watch this video next. Until next time, stay informed, be empowered, and may your investments flourish.